Hello, Matthew with Copley Financial Group, and today we're going to do a market update from an interesting location. I'm here in St. Andrews, Scotland, and this is actually towards the end of a long family vacation this summer, actually starting in Africa. And it's interesting how it all came about. One of our clients actually sold their house and moved and built a safari camp in Zambia, Africa, and been threatening for the last couple years to go down and see them and visit Africa, as I've never been. And then what ended up happening is I had a business conference that I go on every year, every summer with Gradient Investments. They have a conference. They have about 1,000 financial advisors around the country that work with them, and the top 25 get invited to go to a business conference, usually held in a fun location around the world. And so this year was in Scotland. Well, I certainly didn't want to travel all the way from Africa to, or from the United States to Africa and then back, and then travel all the way to Scotland and then back. So I decided to make it all one trip and bring the family. So we're having a great time. Africa is an amazing place, and if you don't have it on your bucket list, you should definitely put it on. And if you're interested at all, I can certainly give you some great tips on where to go and what to see and how to book it. Our clients that have a safari camp there in Zambia, it's just a wonderful place, and it's way less crowded than the rest of the more popular spots in Africa. So, we saw just about everything you could possibly see, including leopard with a kill, dragged up into a tree, lions, rhinoceros, elephants, zebra, giraffes are everywhere, hippos are just everywhere. And so it's an amazing trip, and if you're interested, just reach out. And of course, if you're in for a client review or a meeting, be sure to ask, I'll show you the photos on my phone, all the fun photos of all the wildlife, which is really amazing. So we went to Africa, and between Africa and Scotland, where I'm having my business conference now, we stopped through Dubai. And of course, if you're going to Dubai, you got to go to the world's tallest building. So we stayed for a couple days there in Dubai. Went up to the top of the Burj Khalifa and did some fun stuff there in Dubai. And now we're here in Scotland. I actually just finished up a business meeting, and about 2 p.m. here in Scotland, and which is about 6 a.m. in San Diego time, so a big time difference. But we've been in Africa the last week, so I'm used to the time zone change by now. So as far as a market update, I'm just going to give you a quick update on what's going on in the investment world. It's been a little bit quiet. Summer is oftentimes a quiet time for the markets. Everyone's on summer vacation like me, apparently. But there are some updates I would like to cover with you. The first one is just a quick update on Charles Schwab. That is moving along as expected. We're going to see a complete merger between TD Ameritrade and Charles Schwab come Labor Day weekend, and so they're going to call it conversion weekend is what they're doing. And so you will get new account numbers at Charles Schwab. You'll see a lot of stuff from them. You do have to set up a client login, so you'll have to go onto Charles Schwab's portal and set that up. You'll get new account numbers at Charles Schwab, so be prepared for all of that. And they say it's going to be a seamless transition, but of course, I expect there's probably going to be some issues, mainly around people that have direct deposit or automatic withdrawals. Maybe tax withholdings will be not set up correctly. So our staff is going to work very hard, but no matter how hard we try or how good Charles Schwab and TD Ameritrade are or how good our staff is, I'm sure there will be some hiccups. So just so you know, your money is safe, even if there's a day where your account doesn't show up or something doesn't happen. They are going to shut down TD Ameritrade and Charles Schwab, the entire company's online access over the Labor Day weekend. So everyone that is with either company is not going to have any access for the weekend. And then apparently on September 6th, after the Labor Day weekend, everything's going to be Charles Schwab and everything's going to be great. So we're going to work real hard to make that as easy as possible. Our staff's going to work really hard to make sure that transition is seamless as it can be. So a little bit of update on Charles Schwab. And, what we're seeing right now, the big news, I guess, is the BRICs, the Brazil, Russia, India, China. They're moving along with their planned currency that's going to compete with the US dollar for a world's reserve currency. They have announced it is going to be backed by gold. And this was unexpected to the markets. Of course, I've talked about this in previous videos that I believe that the only alternative to the US dollar would be gold. And so they have decided they're going to back their currency with gold. And this has caused a big jump in the precious metals markets. We've seen about a 10% jump in our gold holdings. They've done very, very well in the last couple of weeks. I expect that to continue, and I do think inflation is going to be worse than they're projecting. That said, the US dollar is not going to just go away quickly and easily. The entire global system is a Eurodollar system. The vast majority of all reserves held by foreign central banks around the world are US dollars, and virtually all transactions between countries, big transactions, are handled in US dollars. And this is not going to have as big of an impact if the US dollar does go away as the world's reserve currency. It's not going to have as big of an impact as you might imagine. If a country like, for example, Egypt wants to trade with Turkey, they might take out US dollars to purchase goods, and maybe they're going to take out a loan in US dollars, purchase something, pay it back with US dollars. And so that's just a direct transaction. If you take out a loan in US dollars and borrow the money and do something between, let's say, Egypt and Turkey, and then you pay back that loan, it's just a wash. There's going to be no real impact on the US markets. The one thing that obviously is going to create problems is the fact that the US dollar is oftentimes used around the world as the reserve currency. So it allows the United States to print dollars, spend the money inside the United States, and essentially export inflation around the world. And we won't be able to do that as easily with the US dollar not being the main currency that is being used. A lot of people say, well, no one's going to trust Russia or China or India over the US. But just those countries alone that are part of this BRICs alliance represent about 40% of the world's GDP. They represent about 70% of the world's population. So we're talking about a lot of people and a large chunk of the world economy. So it definitely will have an impact. I do think it's going to play out a lot slower than some of the doomsdayers that have, the dollar's demise is here. Well, we've been hearing this for years, that the dollar's demise is here. I think it's going to be slow, and it definitely will have an impact. So we want to hang on to those gold positions. I think it's important. Definitely want to be heavy in commodities and value stocks and the stuff that we've been talking about for quite some time. So I think we're going to do really, really well with our current holdings. We don't want to change anything. One area that I do think that I have a lot of concern, and that is the U.S. government's debt service. Right now, we're spending about $50-60 billion a month in interest on U.S. debt. And the government's going to have to start paying out over $100 billion just in the next 12 months. And that's going to increase. More likely than not, interest rates are going to come down. And we're seeing that. All the projections are projecting interest rates coming down. If you look at Morningstar's analysis, says it's coming down. Even the Federal Reserve's projections say it's going to start coming down in 2024. And if you just look at the futures market, the interest rates are going to come down. When interest rates are low, it's a good time to refinance long maturity debt. So if you have a mortgage on your house and interest rates drop, you now can refinance that loan and get a much better interest rate and low payments for the rest of the duration of that loan. Well, the same thing happens when interest rates are high. You want to take advantage of those higher rates for as long as you can. And so now is a good time to be taking a look at longer maturity, take advantage of the higher rates. A lot of people are going out and jumping on these CDs and annuities that are short duration, where they might be able to get the highest rate. But you're probably better off locking in those higher rates for 3 years or 5 years. And that's because right now, if you look at the whole interest rate environment and the market out there, there is very large signals that interest rates are going to drop in the future, which obviously brings up one of the biggest challenges with the US government debt is they really need the interest rates to come down because that US debt service is going to be so large. When you look at paying $100 billion a month in interest, you are at $1.2 trillion a year, you're in a position where it represents the entire U.S. national defense budget in comparison to the interest rate payout. And so that's a real issue. It's a problem for the U.S. government. I think it's very inflationary because this money is essentially going to be printed up to be paid on this interest. And so we want to essentially take advantage of that if we can. We want to keep all of the commodities, the gold positions, the value stocks, which will do well in this environment. And one thing that I will mention is the current rates on the Buffered Index, which I think is a great investment. It's done very, very well for us the last couple of years. And the Buffered Index is something that a couple of our clients have said, hey, can you mention what the current rates are? So I think for future videos, this video and future videos, I'll mention the current interest rates and the caps and everything on the Buffered Index. And so the current Buffered Index offering we have is on the S&P 500. It is a 2-year index. And so you go into it and it's in the S&P 500 and you can earn up to 23.5% over the next 2 years. So that means if the stock market is up 10 or 15 or 20% over the next 2 years, you get exactly that. You're up 15 or 20. If the stock market's up 30 or 40%, you're going to end up with 23.5 over the next 2 years. And so that is the cap. So in exchange for giving up everything above 23.5, we're able to get 2 insurance policies. The first one is if the stock market drops anywhere from 0 to 20%, you actually get the inverse return. So if the stock market's down 10%, not only do you not lose any money, but you actually make 10%. And so that's the inverse return. And that happens down to a 20% drop in the stock market. Now, if the stock market's down more than 20%, then the second insurance policy kicks in, and that is just a 20% reimbursement on your loss. So if the stock market was down 25%, you'd get reimbursed 20, you'd still be down 5%. So this is a great way to invest in the S&P 500, have some protection against a big drop in the market, and still allow for some great returns. I mean, 23.5% return over the next 2 years is going to be a pretty good rate of return. I return to the office on Monday, July 31st, and I look forward to seeing all of you. And be sure to ask me to see the pictures of all the animals in Africa, which was pretty impressive. So thank you all for watching, and I look forward to seeing you in my office very soon.